search who are people. Yeah.
Yes.
Hello everyone. Can you please, one of you please confirm if you can hear me clearly?
Can. Yeah, we can hear you.
Great. Thanks a lot. So for the duration of the management's presentation, I will request everyone to be on mute. Yeah. And with your permission, I will start recording this call. Just give me a moment.
This meeting is being recorded.
Good evening, everyone, and welcome to Aptech's FY24 Investor Analyst Call. We have with us today the entire management team. Some of us are here with me in the room, and some have joined on a call from elsewhere. The call flow today will be that after my initial welcome, our Dr. Anush Kakar, he will give the opening remarks, and then he will pass the floor to me for taking you through the presentation very quickly, and then we will open the floor for questions. Yeah. And as I mentioned earlier, please be on mute for the duration of the management's presentation. And once we finish the presentation and begin the Q&A, I would request each one of you to raise your hands, on Zoom, and then we will call out the person who can ask the question. Yeah. So I will hand over the floor to Dr. Anush Kakar to give his opening remarks.
Thanks, Saurabh, and welcome all of you to this investor update. Firstly, thanks not only for being on the call today, and especially in the context of the much excitement which is there in the markets which you all part of. I think for making the effort to be here today at this very crucial time, a sincere thanks. A sincere thanks also to you for reposing your trust in the company over the years and being part of our shareholder community. So what the idea here is that I would first give you a little bit of a preamble as to what we feel is and how we see things happening, both in the immediate preceding years, as well as the industry in general and Aptech as a company, how it has been doing, and how does it look at the segments at which it operates. So in my initial remarks, I would like to, this will be probably about 10 minutes odd. I like to concentrate on that, and then Saurabh will get into the specifics of the numbers and what have you. So last year, clearly, as you must have seen from the investor update and our results, has been a bit of a mixed bag. While most of you know that we have two major segments. One is the retail segment, and the other is the enterprise business group. So while the retail segment did relatively well, there were setbacks on the enterprise business group as far as growth is concerned. In fact, the growth in the retail was offset by the negative growth in the EBG segment. However, you need to bear in mind, for comparison's sake, that while there is a degrowth the previous year, the reference year for the degrowth was the kind of a bumper year, if I might call it that, for the EBG segment itself. So there was a high base to work on for EBG, over which there was a degrowth, which offset the growth in the retail. So it's a bit of a mixed bag, and there was a consequential impact on the profits. That's far as, and if I look at the retail segment per se, there has been healthy growth despite some very severe headwinds that we've faced. And there are also some good tailwinds behind us. Now the good thing is that the headwinds seem to be of short-term nature, and I will elaborate a little bit on that as well as to what happened. But the tailwinds are, more sustaining and of a longer-term nature, and we think they will last for a long time. And therefore, net-net, as we look into the future of the segments that we operate in, we are very, very bullish. Now, Our center network also continues to expand. There has been net increase, which also shows that there is confidence in the partner community at large to be able to take on additional centers and new faces coming into the system. So the confidence is not only internal, it is also external in the partner community, which is obviously a good sign. Now, I need to take you back to be able to understand where we are and why we are where we are, looking into the future. I need to tell you a little bit about what we believe has been the Aptech story in the past, and how does this story help us align itself to the future. So bear with me if I take you a little bit too much into the past. It is with a purpose. The Aptech, as most of you would be aware that, we started way back in the 80s when IT was just about coming into India. In fact, if you go back to the 80s, and that's as far back as the IT story goes in India. And IT was just coming in. Aptech came in at the right time and started training in IT and computer literacy, catering largely to the US market. Then we caught the IT wave, as it were. As IT story went up in the world, around the world, Aptech grew along with it right till about 2000s. The next wave came in the area of multimedia. So by the time the wave of multimedia came in the late 90s, early 2000s, Aptech had already positioned itself in the multimedia training space to Arena Multimedia brand. So we caught the multimedia wave also. These were followed by in quick succession by other waves. Like early 2000s was the animation wave. We saw that the animation is coming up or likely to come up in the country, and there's a high growth story behind it. So we introduced courses in animation. In fact, we went to the extent of changing the name of what used to be called Arena Multimedia to Arena Animation to be able to give a very sharp positioning to this particular segment. Although at that time when we changed the name, there was a very small percentage of the business coming from the animation vertical. Moving quickly ahead, 2010 thereabouts, we acquired MAC, which was an acquisition in 2010, operating in areas while in a similar way to the Arena, but the positioning and pedagogy of MAC was very different, so justifying the acquisition, and that has again proved to be one of our success stories. Then came the visual effects wave. We had introduced courses right in time. Then very recently, about 3-4 years back, the gaming started coming into a big way. So we introduced courses of the gaming in the right time, and immersive media came in. So if you take the story in conjunction, this whole thing, what does this tell you about Aptech? It tells you that the success of Aptech has been based on its ability, or rather the DNA, of being able to see these trends relatively early, as well as various technology spaces which are coming up, which are likely to have mass employment potential, and where education can be done in a distributed manner, and where the appetite for this is mass and not niche. Combining all this is where Aptech has been able to define itself very successfully over the last 3 decades. Now, during this time, what also happens is we also become very unique in this education vertical. All of you have scanned the market. All of you are very familiar with the many companies and players who are there in the education vertical. You will be hard pressed to find an exactly duplicate entity which is closely resembles Aptech, which is both a good thing for us as a company, maybe a little difficult thing for you as an investor, because you lose a comparable benchmark to do it. And therefore, it befalls on us to be able to explain to you what Aptech is all about and how we perceive it. Therefore, for you to be able to assess us as a company and our financials. So now, from there, you must have read both in the presentation and in other press reports that we have launched something called the Virtual Production Academy. Now, virtual production is one of the latest techniques of filmmaking, which has various technical advantages, which we feel are likely to grow in the future. So it is also a continuation, as it were, of our story of being able to catch or spot trends early enough, place ourselves ready in the market with pilots, with initial forays, so that if the wave comes, and as it comes, the market takes us up, as it has done in the various examples that I cited. And it is that story which we expect that we will continue into the future. And I will talk a little bit more on this as things come up. No story today is complete without talking about Gen AI in particular, because that's because of the flavor of the month, if you want me to call it in a very loose fashion. But however, calling flavor of the month is missing the point. The point is that it is a transformative technologies which are coming up, which every company, and perhaps every individual needs to be able to track to see what is the impact potentially for the individual or the company concerned. And we have been no different. We have been doing very structured fashion around the areas of Gen AI, broadly divided into three buckets. One is the area of how do we prepare students for being ready for the future world of Gen AI, which they will be entering into. The second is how do we use Gen AI to improve productivity within the company. And third bucket is how do we use Gen AI to deliver better deliverables to our partner ecosystem. So in each of these buckets, there are various initiatives, and if there is appetite for further detailing, I can talk more about it in the question answer part of it. The thing, suffice to say at this stage, is that we have a very cohesive strategy in place, which is already underway in terms of implementation, to be able to do this part as well. Again, keeping in view our ability to spot technological trends and use that to our advantage. We have also worked on re-strategizing our enterprise business growth, which certainly needed some degree of re-strategization. And during the course of the presentation, we will talk a little bit more about it. A broad thrust of this re-strategization is centered around reducing our concentration risk across a major customer or one or two major customers, and to be able to spread ourselves better, so that the vagaries which are inherent in the or the lumpiness which we have witnessed in this business of ours, we are able to mitigate that to the extent possible. And we have also been introduced some new products into the EBG mix, and we have re-strategized our customer acquisition strategies, including the kind of customers that we are talking to currently. So there's a relook, and we make a relook completely on that as well. Overall, the focus is on building a strong, predictable, and sustainable growth. As you will see across a three decades history, so many players have come and gone along the way in areas which at one point of time have directly competed with us, and either they have gone on different paths or they have fallen by the wayside. But yet, Aptech not only has been able to do well, but it has been able to adopt areas of market leadership. For example, in the area of media and entertainment, we are clearly, between Arena and Mac, the largest player in the industry. In the area of beauty as well, we are one of the two most significant players in the industry in terms of the number of students that we are training. So there are clear methodologies, clear strategies which we have been able to build up across the decades, and we will talk a little bit more about this during the presentation itself. The other thrust, last point I want to make is that some of you at least would may be aware that this year has been a transition year, so to speak, for the management. The broad thrust has been that of continuity with change as far as the organization is concerned. While I personally, as CEO interim, took over in July last year, but in this year we have practically inducted many new faces in our CXO team, and all of them are here with me I'm happy to introduce the team to you. The new faces, we have Sandeep Belling has now joined us as the Chief Business Officer for the Global Retail Vertical. He comes with a long history and strong expertise in the retail space in various industries. Neeraj Malik is an old face to many of you, but he had left in the middle, and we have the pleasure to re-induct him into the team as Chief Business Officer for the Enterprise Business Group. We have Pawan on my left. Pawan has joined us as CFO designate. Mr. Ravi Shankar, who is on my right, after a long innings of 24 years, is retired due to retire at the end of June. So Pawan has already been brought on stream, and so that to enable a smooth handover from Ravi to Pawan as far as the financial world of Aptech is concerned. Besides this, crucially, we also have Parag. Parag has joined us as Head of Technology to bring new ideas and bring strong technology focus to the company. So these are just what I'm talking about, the changes at the CXO level. So of course, I have been with the company for a very, very long time, and therefore you will clearly see that there is a very happy blend of continuity with lots of new faces and change and new ideas, which will hopefully take the company into the next orbit. So with that kind of a very generic preamble, I would now like Saurabh to take over and take you through more specifics of what we are and where we are. Over to you, Saurabh.
Thank you very much, Anuj. So I will quickly run through the presentation. I'm sure you would have gone through it, and most of it is very self-evident, but I'll just highlight a few things. So as Anuj mentioned that, it has been a mixed bag where, the retail business has done relatively well, whereas, we had setbacks in the enterprise business group. But net, if you look at, how we perform, so, on the profit side, while overall profit is down, but the retail PBT has gone up significantly. And if you also adjust for the FX impact that we had in some of our key international markets, the growth would have been much higher. The cash position again, remains very comfortable, and we have 199 crores of cash at the end of FY24, and there was good free cash flow generation overall, specifically because of the good performance in the retail business. The Q4 was also pretty good, but we will try to focus more on how we did in the overall financial year. So some of the headwinds that Anuj spoke about. So one of the key things that affected our business growth in the media and entertainment segment in retail was the strike in Hollywood. So many of you must be aware that the writers and the actors went on a strike in Hollywood, and which halted a lot of the production that was happening in US, and it had a lot of downstream impact as well, and it affected the job growth in India, because many of the studios and companies who recruit from us, they essentially work on the outsourcing projects. And that's where you see the overall industry itself, which was projected to grow at 24%, right? The animation and VFX segment of the M&E industry was projected to grow at 24%, but the actual growth was only 7%. So that did affect our M&E business, but we still managed to grow that segment. In the second largest segment for us, which is the beauty segment, again there we had a lot of aggressive competitive pressure, and we have done a lot to address that, and we can probably cover more when we get to the Q&A. So Nigeria, which is our second largest global market, it saw its currency depreciate almost by 3.5 times. Right. So if you see the level, so it was around 460 levels in May and before that. But then because of certain decisions by the local central bank, the currency against USD went up to 1618, right, which is a huge depreciation, and it did affect us in 3 ways. So obviously it affected our revenue, which was lower, and it also affected the outstanding that we have, the debtors that we had. So the revaluation of that was an impact that we have recognized in our P&L as an exceptional item. On the EBG side, essentially what kind of worked against us was that some of our larger customers, they moved to paper and pencil mode for conducting the exams, and while we had agreements with them and which continue to remain active, we did not get specific work orders for executing some of these exams. And that is the reason why you see a major degrowth in the enterprise business. And in some cases, the exams did not happen because of the elections that were held and the model code of conduct that kind of came into effect. So in terms of the key operational highlights, most of it is self-explanatory, so I'll not go into details. But if you look at the last point, essentially, in the context of what Anuj mentioned as to what we are doing to kind of re-strategize in our enterprise business. So one of the elements is to have more customers who can give us larger volumes, and that is where we have been able to get empaneled as the online testing partner for 3 new customers. So some of the key initiatives that were taken during where Anuj has already covered the first 2 and to some extent the last one as well. So the other initiative that we've taken is that to leverage the large alumni base that we have across brands, we have launched a tech platform called Alma Nation, which will help us engage with that alumni community, and not only help us by kind of giving our prospective students an access to the success stories that we have created over the years, but also get referrals from the alumni community, and also try and engage with them to get them to come and talk to our students for various workshops or other platforms.
Sorry if I might, with your permission, interject. See, on this Alma Nation, you need to understand that from an investor perspective, what does this mean? Aptech as a company has been the company which has been in existence for more than 3 decades. And therefore, by that very definition, has an alumni base with outsell, which is so large that no other brand can even come close to it, even if they started, let's say, in the last 5 years. So this by itself becomes a USP for Aptech as a company and for the specific brands for which we have. Because the sheer largeness of the thing, they become like brand ambassadors, they become like referral partners, provided we are able to reach out to them in a manner which is beneficial for them. And that is what this Alma Nation is doing. I'm happy to inform you that we started this less than a year back, and already from 50,000, if I'm not wrong in my figures, around 50,000 alumni are already part of this network, interacting with not only with each other from a nostalgia sense, but also interacting and gaining from where we have jobs being posted for them for lateral transfer between two companies. There are seminars, there are various things which are useful for them in their life. So over a period of time, what we hope to build is a platform where we are then able to claim over a period of time that listen to the student who is entering us today, that we are not with you only to get you your first job. We are going to be with you for your entire 30 years of professional life. And that becomes a huge catapulting value proposition, which is absolutely impossible for anybody to meet by very definition of time.
Thanks, Anuj. So on the enterprise business, just to add to some of the other things that we are trying to do for de-risking it. So we have also started focusing on some of these scalable training initiatives that are being taken by various governments and private bodies across the country. So this is something which we have started working on and will be focusing on going forward to sort of diversify from very heavy focus and reliance on the assessment and testing business. So this is the management team which Anuj has already done the introduction for. Right? And he spoke about the Virtual Production Academy, and we spoke about these are some of the awards that we received during FY2024. I'll just quickly run through the operational metrics and the financials. While the numbers that we have disclosed are more or less consistent with what we have disclosed in the past, right? So I will quickly run through the slides and only highlight some specific points. So booking and billing, as you are aware, that these numbers are in INR lakhs. So this is for our domestic and international retail and global retail segment. This slide has the new center that we have signed up in the domestic and international market, and what is the position on the total centers. And for the various financial years, what was the same store growth when it comes to booking and billing. So these are the segment results, where you can clearly see that the revenue growth in global retail is encouraging despite of headwinds that we had, and the profit growth also would have been better if we adjust for the FX impact, right? And we have given distribution of the domestic and retail revenue and the performance in terms of the growth. So you see that international retail growth is muted again because of the FX impact that we had. One thing which I would like to highlight is that when we say unallocable expenses, basically these are expenses which cannot be allocated to either of these two segments. And we have given net unallocable expenses because we have netted off the unallocable income as well. So some things like the interest income and dividend income, such things are netted off from the unallocable expenses, which you can see has come down significantly, but that is largely on account of the unallocable income going up due to higher interest income. So this is the P&L numbers, so self-explanatory, so I'll not go into the details here. We have also given the exact impact, when I say exact, it is an estimated impact of, on a like-to-like basis, if the FX rate would have remained same as last year, how different our revenue would have been. Since in case of the retail business, most of the revenue flows down to the profit level, because any incremental revenue, I'm saying, will flow down to the profit. So this entire 507 lakhs would have flowed to our PBT, and this is also covering the impact of restatement of debtors and bank balance. So the 126 lakh and 585 lakh, totaling up to around 710 lakhs, is basically recognized as an exceptional item in the P&L. Something that we have done very well in the last year is we have managed to reduce our debtor days by a significant number and have improved our collection a lot. and that is also reflected in the free cash flow. So, if you, what we have tried to do is that the company free cash flow is the red line, right? So you see that the free cash flow came down from 82 crores to 42 crores in FY24, but that is largely on account of the loss that we had in the enterprise business. Now, if we adjust for that and try to assess roughly, what is the free cash flow generation in the retail business, right? So then you will clearly see that there is a reasonably good growth in terms of the free cash flow that the company has generated if you adjust for the enterprise business loss. So the last slide basically talks about the return ratios. We have obviously also tried to give you a flavor of if we adjust for our large cash holding, then what would the ratios would have been. So the brown line basically talks about the ratios after adjusting for the cash and cash equivalents. So that is all from our side, and we would now like to open the floor for questions. So whosoever has questions, please raise your hand. I will we'll ask you to give your questions one by one. Yeah. So anybody who has questions, please raise your hands. Okay. So the first question is from Ashwin Reddy. So Ashwin, you can unmute yourself and ask your question.
Yeah, hi. Good evening, everybody. Thank you for the opportunity. So I have a few questions. So I just want to start with this. Could you talk about the current placement season as to how is it going now? I understand the strike impact was there before, but given the strike is now ended, what is the current placement season like? And what are you seeing that in terms of trends now?
Ashwin, would you like to ask all the questions at one go, or should I keep responding?
No, you can keep responding. Maybe we can also go deeper.
Okay. I think, yes, as you're right, the strike didn't impact our placements. The strike has ended end of last year. We just qualified that by saying almost ended because there are many dimensions to that strike. The work has started trickling in back to the Indian studios, and thereby it will start picking up. But my own assessment is that it will take at least a quarter more before that really be back to momentum on those fronts. I think more than actual placements is the sentiment which counts in our kind of an industry. It is not that when we enroll somebody, he's going to be placed tomorrow. So it's not a short-term correlation between that. But the issue is that of sentiment. The sentiment did get impacted last year, particularly in the second half of last year, although the strike started in the first half. So while we had a phase lag on the impact, we will also have a phase lag in the recovery. So, but the good news is that it's coming back. However, I would like to also qualify, not overhype the issue of the strike. While that was the impact of last year, I think what is also the industry itself is readjusting itself. Today, the skills that we teach are not necessarily skills which are utilized only by those studios which are catering to the outsourced servicing market. There are many domestic studios who are much smaller in size, but who are doing great work in producing domestic content. So our students get jobs there. There are many areas which are not related to films itself, but find very good job opportunities for our students. The gig work is coming up in a big way. So there are multiple things which is today happening around the area of employment or freelancing, which is helping a student to get employed or gainfully otherwise earn his livelihood. The issue still remains a bit on the sentiment part rather than the actuality part.
Sure. So, but then surprisingly, the impact is much more in numbers is what I would say, right? Is that the case? Because if I see the bookings number, right? Even the bookings number has been much slow versus last 2 quarters. So if you see Q3 and in Q4 versus last year Q3, Q4, there has been a drop in bookings as well, which would reflect now. But the additional jobs or the opportunities which are coming up potentially from the newer sectors or newer gig economy, is that visible in numbers for you guys? Is that how you're seeing it?
No, see, it's like this. If you look at it from an industry's perspective, what Saurabh showed you, animation and visual effects, as per the Picky Frames report, which is one of the most referred to report as far as our industry is concerned, had predicted this year to be a 24% growth. It finally landed up ourselves at a 7% growth. As compared to that, our billing growth, which is really more closely trackable on the fresh intakes as well as continuation of those students, is 14%. So clearly we have outdone the industry growth rate. So that's a solace of sorts.
Got it. See, but okay,
lower, 14% is lower than our earlier history. Point taken.
No. So what I was getting to is when we speak to the studios, the feedback that we're getting is the entry level work is at risk in terms of being done through systems versus being done manually. And when we see the opportunities for Aptech grads, I mean, you start low and then you would go up the chain, right? That's how it is typically for any industry or company. So even though we might adapt the coursework to keep it ready for the next generation, for the next requirement, but what we are known for at Aptech, so would we attract that specific kind of talent? Okay, I understand you started this VPA, which is good, which is what is needed, but we're not known for that, right? I mean, Mac and Arena are known for a certain level of say certain kind of students. Now, how would the transition be something what I'm trying to understand? And how would the economics of VPA be for you? How large can this become? Some clarity would be helpful there. As to how
thanks for the question, which gives me an opportunity to explain to you and perhaps correct some perceptions you may carry. Let me divide this into 2 parts. One is the perception-based thing, which is arising from the strike. Let's assume for a minute that is over and behind us. Let's talk about the other part of it, which you talked about, is what Mac and Arena are known for. That is a little bit of a misperception that you carry. Yes, there will always be some technologies and something which will fall prey to automations, which will happen. But we've been in this business for 30 years. We know what those are. We know how to adapt our courses to ensure those don't happen, upgrade our students. That's what we earn our living from for the last 30 years. So we go on adapting our courses. It's not that we continue to teach exactly the same thing which we taught last year or the year before that. We constantly upgrade our courses to be able to keep them relevant for the students, not even relevant for them today. They have to be relevant for the time that he's going to pass out from the system. So that is the core strength which Aptech has, and specifically Arena and Max, since we're talking about that industry. So the misperception which you would like to correct is not that we are teaching the same thing. Actually, like the ship of Theseus, we don't teach anything which we taught earlier.
No, sorry,
everything carries on.
Can you step in here? See, because my point was the student segment which is coming to you, like the typical plus 12 pass or the typical audience which you're catering to, was not changing while like you mentioned, you were changing and adapting as the needs changed, but the audience which was coming to you was almost the same. But here, if the studios here have a pressure from their clients in the US that that you need to use technology to automate the low-end work, would you need to adapt to a newer segment of audience? Is another question. And would there be a difference in the way you cater or in the way you brand, or how do you think about that?
Yes,
that's needed.
I think the multiple segments have always existed. It's not a product of what has happened in the recent past. Okay, there has been multiple segments, and if I can, our own segment, which you are very right in your observation, our segment which was relatively narrow is now more broad-based, relatively speaking, with still the median being the same. So we have people even in schools. We have people even coming from in class 10 and class 12 who are there. we have many working professionals coming to us. And you mentioned virtual production. Virtual production, largely what we are doing today is catering to the entirely virtual product, working professional market who are coming for a upgrade or a reskilling of that segment. So yes, you're right that the product is the customer segments that we are talking about has broad-based itself, but so have we. I mean, those are the normal business adjustments and things which kind of do it on a day-to-day basis in our life here. So you have to take one thing into factor. Fact is that we are biggest in the industry. The fact that we have been in existence, not only in existence, and thrived over this period. Today, you will find it difficult to go to any studio in this country and not find an Arena and Max student there. And therefore, that, to my mind, should be evidence enough to you to be able to say that these guys know what they're talking about, and we go on adapting. Not only you mentioned only the issue of technology and the different segment. There are various other dimensions to the adaptations. Let me give you one case. We have a new education policy which the government announced, which opens up different avenues and different segments for us in the school segment. So that's another area for us to look at as a potential segment and even a current segment for that matter. So we're doing many things around that as well. That is hygiene for us as far as adaptation across these multiple different drivers are concerned. Now you multiply this by different geographies and we are quite adept at dealing with those different complexities. I think in the interest of time, I think Ashwin, we can go on this topic for a long time.
So I have more questions. Can I continue, or do you want me to come back in the queue?
Maybe we can come somebody else, and then Ashwin, you could come back.
Okay. Come back in the queue.
Yeah, so next question is from Sunny. Sunny, you can unmute yourself.
Yeah, thanks for taking my question, and good to see the team after such a long time. So basically, my question is around global retail. So the presentation highlights that the global retail segment has grown at 34% in terms of revenue, but the PBT growth is only 11.5%. So basically, I have two questions here. One is, what is the impact of currency depreciation which has impacted the segment PBT? And second is, in my understanding, the revenue growth also appears high because of the change in accounting method that we have implemented. So what's the core underlying revenue growth on a like-to-like basis in terms of the pre-accounting change revenue growth?
That's a fair question, Sunny. I'll hand over to Saurabh to give you the like-to-like estimated comparisons. While the official figures are what they are on the screen.
Thank you. So, Sunny, if you were to just look at like-to-like growth, if we would have used the royalty model in FY24 as well and FY23 as well, then the revenue growth in retail would have been 8%. But if you additionally adjust for the FX impact, right, which is around 5 crores, then the revenue growth would have been 10% at the retail level. And profit numbers. So our reported profitability is 11%. And if I adjust for the accrual to student delivery method, from royalty to the student delivery method, right, then my retail PBT would have been 9%. And if I, on top of that, if I adjust for the FX impact, then my retail PBT would have been 16%. Yeah, retail PBT growth would have been 16%. So, 10% revenue growth after adjusting for FX and the change in the model, right? And 16% PBT growth for the segment.
Got it. So that's quite helpful. My second question is basically on the beauty segment. You have highlighted in the presentation that you face competitive intensity from local and regional players. So, basically, do you see this trend sustaining? What steps have we taken to address that in terms of our course, in terms of our pricing, and do we, so at an overall basis, 10% growth in retail, global retail business is, I understand, partly also affected by the animation segment, but how should we look at growth going forward, either in terms of domestic, international? So some color on that will be very helpful.
You are referring specifically to the beauty segment?
So basically, one, competitive intensity in the beauty segment, and second part of the question is how should we now look at growth in the global retail segment going forward, with now FX impact in the base, with animation related the Hollywood strike related impact also in the base. So how should we look at growth on an overall basis going forward?
Okay, let me first deal with the beauty segment question. Beauty segment has been competitive ever since we entered it. So it is, in that sense, not a new thing for it being there. The reason we have highlighted is from the point of view of the intensity of the competition having increased. Not that it has suddenly become competitive. This industry is a very, very fragmented industry. And there, what we see trends is that of some degree of consolidation happening within the industry. That is one. Second is some of our major competitors seem to have got some external funding, which they are literally using in the market to aggressively market themselves, which is a fair competition, which has built up the pressures on the beauty segment itself, which has also impacted our average realization in the market, which has also dampened our growth rates. Having said that, it is not something which is it is to take note of and not really to get worried about, because it's part and parcel of any consumer markets. So we have, in terms of response, we have significantly changed our product portfolio. We have added many new different products in some new segments which we didn't operate in. We have added, with the help of Lakme Lever Private Limited, who is our partner here, added some completely new ways of doing things in the beauty segment, which is now building up to a sizable volume as well there. We have intensified our own marketing activities, both on the digital and the non-digital spaces, to be able to meet the competition. So overall, if you look at this is in terms of direct competition, but really you have to broaden this and look at what's happened in the industry per se. This industry, and now luckily we have some data to go by, the Beauty and Wellness Sector Skill Council has come out with a report which is talking about a very healthy growth rates. I don't remember it off, but it's in the mid-teens, the growth rates which they have projected for this industry. So overall, as the industry grows that much, even if we retain our market share, we should grow by that percentage, at least. But as we speak, through addition of products, through addition of markets, through addition of geographies, we should be able to do it. But we still continue to do this only in India. Your other question was with respect to the international markets.
Overall global retail.
Overall growth outlook, domestic, international, from the retail side.
Yeah, as I said, if I look at again external reports for validation of our internal assessments, and I go back to refer to the FICCI Frames report, they are talking about 17.5% as the projected growth going forward, CAGR over 3 years. So I think it clearly is a growth. Now, on top of this, you can add the multiple other drivers which are over and above this, which is areas into new geographies, which is something which is kind of exclusive to us in the area, because we have the ability and the proven track record of getting into newer geographies with our products, mainly in the media and entertainment side as well as in the IT side. So, I don't think...
of related person.
Sorry? Yeah. So overall, these are the benchmarks to use. At the end of the day, you have to remember we are an ancillary to the employment industry. And therefore, in some ways, our growth is to be pegged alongside that.
Got it. Thanks for the detailed response. And I have one last question before I go back to the queue, which is on the institutional side. So basically, institutional business has seen a sharp drop in revenue for the reasons highlighted in terms of tests moving back to pen and paper. So basically, how should we now look at the institutional business with some new customer additions, with the existing customers already being empaneled? How should we look at growth coming back in this segment? And also, in terms of the economics of this business, so what is the break-even level of revenue that we need to achieve on an annual basis so that we don't lose money in this business? And what kind of profitability is possible at a assumed scale? So some color on that will be helpful.
Neeraj, you want to comment on the strategy on the EPG business?
Yeah, sure, Anush. Thanks. So thanks for the question. It's not one question. I find that it's a set of multiple questions here. I'll try and answer to few of your questions. Let's see. As far as government took a decision to, or client took a decision to move to paper and pencil, but if you see from the other side now, government has intent is to encourage online examinations for all their departments, and which is Digital India, and they've been doing that. In fact, government has made some certain decisions in terms of investing on infrastructure to boost CBT at a larger level. Right now, the market is still very, very large.
Neeraj? Sorry, we lost you in between.
Am I audible?
Yeah, you're audible. Carry on, please.
Yeah. So, government's focus is very clear to invest on infrastructure to give a boost to the CBT examination, and it is in a full flow today. So, as far as the opportunities are concerned, it's phenomenal. As your other question was in terms of in terms of our strategy today, we have re-strategized EBG, right, to reduce concentration risk and expand our product basket. Anuj has explained initially also that we have taken a lot of initiative. In fact, more from a perspective within EBG, if you see, instead of focusing on one large set of customers, one or two large set of customers, we have de-risked by getting 3 large clients for the organization. So there's a first level of de-risking which we have already done it. Your third part of the question was in terms of break-evens. These figures are not there in public, so we'll refrain right now in terms of talking about any break-even numbers, while we are also working to minimize the break-even points for the business to ensure profitability, and that's a continual exercise for us.
Sure. And basically these 3 new customers that we have signed up, so from what point they will become revenue generating, and basically should we see revenue from these customers in this financial year or next financial year?
Yes, I won't be able to give you the exact months, but yes, definitely. And we all know country has just finished the elections. So because of, all the government functioning gets paused for a time being, and we're very hopeful now, it should start definitely in this year.
Okay, great. Thank you for all the answers, and look forward to interacting with the team very soon.
Yes, thank you so much.
Yeah. Ashwin, with your permission, I'll ask Apurva to ask the next question, and maybe I'll come back to you again. Apurva, you can ask.
Hi, Neeraj. My question is to you on institutional side.
Yeah.
What will be the current order book? Like, do we have any figure?
So, sorry, would you like to take that question now?
Yeah, sure. So, Apurva, we do not intend to disclose any order book number because, earlier also when we said it was more of a projection based on the contract that we had, right? And said earlier that, last year the actual orders did not materialize. So it is something which is an exercise in futility to give a certain number because it is not certainty. So effectively it is a projection, not really an order book. So I don't think we'll be able to give that number.
Okay, and how long will it take to be a stable business?
Okay, so we have talked about initially and multiple times in this discussion, and I want to re-emphasize that the steps which we have already taken and we are taking, which will is primarily from the perspective of stabilize the entire business and also to reduce risk. And so instead of focusing on one or two large customers, which has been which you all have witnessed in past, instead of one or two, now we have 3 already with us. And there are certain more empanelments which team is working on ground to get it done. So that, and these 3 also where we have been empaneled are pretty large set of customers for us. This risk has already been hedged to some extent, and we are continuing this regime to reduce risk for the organization, right, in order to bring more stability and sustainability.
Yeah. You need to understand that empanelment is not equal to an order. Empanelment is the first step to the order, and then it flows once you have that.
So they have a potential to become a large customer based on the volume of tests that they do.
Okay, fine. And then other question is it not good to demerge this business and list it as a separate entity?
I'll take that. No, I think that is not the current intent of the company.
Okay, because this particular business has been struggling for long. It comes up and then again goes down. It also reflects on the valuation of the overall good retail business.
Yeah, your point is taken. The board is cognizant of this nature of the industry, and the board has taken the view that it will continue in the current shape and manner.
Okay. Thank you.
Thanks, Apurva. Ashwin, you can go ahead and answer.
Yeah, hi, thank you for that, Saram. So, my first question is on Lakme. Right now, in terms of percentage contribution to retail revenues, what is the scale of Lakme approximately? And how do you think about it from here in the next 5 years? Because I understand in the past it was a good growth story for you guys. So now where is it in terms of...
It is a good story for us.
Okay.
I do not have the figures offhand for it to share, but maybe
just give me a minute.
Would you have, Kumshi?
So you could say what?
Share of the pie.
Share of the pie would be close to about 40% of the total.
Total billing integration be roughly 90% the 3 main brands, right?
Yes.
In the domestic business. Okay, subject to my corrections on validation, the rough figures would imply that if you look at domestic business, about 90% of the business comes from Arena, Mac and Lapa. Of this, 90%, and I'm giving very approximate figures, would be 32-33% maybe Arena, 30% maybe Mac, and around 25-26 maybe Lapa. But all would be in the 25 to 35 range between the equally divided between the 3 brands. International product mix is different, which is divided between roughly again subject to correction, about 55% towards IT and about 45% towards Arena.
Understood. This is very helpful actually. So in the past, Lakme has grown faster than the...
They're more or less in the ballpark. More or less in the ballpark, right? Yeah.
So in the past, Lakme has grown faster than Mac and Arena. Will that continue in the next 5 years? Do you think that will continue?
You want Arena and Mac to grow slower?
No, because see the point was Lakme started. No, the point was
I don't want to pass on in a lighter way, but obviously we want all the businesses to grow, and they are independent growth rates. They belong to very different industries. Therefore, one growth rate has nothing to do with the other growth rate. Having said that, I mean, Lakme approximately is now 6 years into the game, maybe 6.5 thereabouts. Part of the initial growth is through expansion of the network.
Right.
As you go on expanding network, and then it's more of same store growth, which drives the growth. So both the things are happening, but the underlying of the growth of the industry itself will drive the growth going forward. I think we are reaching levels which I don't think there will be too much of growth coming from the expansion of the network itself. And Sandeep, you can correct me if I'm wrong.
No, you're right. But what we are also observing is in the metros and the tier 1 towns, going forward, we will not see that kind of growth that we saw in the last 3 to 4 years. We will have to go to tier 2 towns to drive the growth, which is the network expansion, which is what Anuj is talking about, right? So this is the broad story.
Got it. So in fact, my next question was on that, because if I see the new center openings, this was the lowest in the last 8 quarters in terms of the new centers which got opened. We just had 10 centers which opened in this quarter, right? Versus the high number in the past. So what is the number that you would want to work with in the next 2-3 years in terms of the new center openings for you?
So this is purely with respect to the health.
Mac Arena. Say with Mac Arena.
See, all the 3 brands are very different in terms of their network presence. So Arena is quite reasonably or adequately penetrated, I would say.
Okay.
In tier 2 and tier 3 towns also. The best penetrated out of the 3 brands is Arena.
Okay.
Mac and Lapa are almost similar in terms of their penetration. And as we speak, there is enough and more potential or scope to get into tier 2, tier 3 towns on expansion.
Okay, so both Mac and Lapa, for both of them.
Both Mac and Lapa, and that is going to be our strategy for FY25 and beyond also. We want to focus on the periphery markets, where we have not been able to focus in the last, and it was by design. So we wanted to focus on the main metros and mini metros, which we have done adequately well. Now we want to focus on the other markets. That is going to be our strategy.
And going forward, and if I look into the medium term, there are going to be several newer opportunities. One will have to stop thinking in terms of necessarily this center-based counts and all of that. It has never been the good parameter while we disclose it, and I know investors like to look at it in that perspective, but that's not really the way to look at this business. I mean, you can look at it and arrive at a percent revenue because you like dividing one number by the other. But it's not really a great way of looking at this business because the spread is too high. I mean, per center makes sense if the spread is low. Per center stop making sense if the spread is high. And the newer ways of education, newer ways of delivery will itself make part of these calculations little superfluous, for whatever better word.
Understood.
We can continue doing that while it's there.
Got it.
Going forward, this is not something which we focus on very closely, while we monitor it certainly, but it's not directly correlated to a revenue number.
Understood. Helpful.
Now you will have partial deliveries, you will have mixed deliveries, which have already started. Part of the course is being delivered centrally, while the rest of it is being done by the center. Even at the center level, there is mixed delivery. So there's so many things happening which is not relatable to a center count.
Okay, understood. And my last question is on the EBG business. So now is on the enterprise business, my last question. So in the past, we had a strategy of going after large accounts when we started this. And then we changed our strategy to go after the smaller accounts to de-risk ourselves. Now, I'm just curious, what has changed again now that we are now trying to go after larger accounts? Because I think after
I don't know. I think that's a miscommunication, misperception. I don't think we're trying to go after large. We've got these 3 empanelments which have potential to be large. That's about all. But our strategy remains to be able to broad base our customer base. That is the essence of the strategy.
Okay. And could you talk about the, because I understand, I heard the point about the new products in the enterprise business which you're talking about. Are these focused on government or non-government, and how would these be different versus what you have now? I mean, I'm just trying to understand.
I don't know whether, Neeraj, how much you would like to talk about that, Neeraj?
The concentration will primarily be again coming from government.
Okay.
It's a new alternate product lines. It's a periphery business which we are entering into. So it's the same thing, but it's a different flavor, leveraging the newer technologies, creating more value with our government clients. And also, of course, there's a private segment as well. So we're in the process of doing a lot of diversification in terms of creating a lot of product lines, again, from a perspective of de-risking and bringing sustainability in the revenues for us.
But is there a point or a milestone that you want, at some point at which you guys would say that the enterprise business does not make sense for us anymore? Because the context I'm asking this is, if I go back in 10 years, we just took the data, the cumulative EBIT from the retail business is 519 crores, while the cumulative EBIT from the enterprise business is 53 crores. So is it worth the mind share? Is it worth the effort is my point. Because see, we've gone through cycles in enterprise, right? It's nothing new. We've been there for some years now. I understand COVID has come in, then you had issues, then government flip-flops. I understand. But if that is the nature of the game, and if you have a better business here, would you want to spend your mind share, time share on that business? And what are the milestones you want to say, or what time you'll say, fine, this is enough, and then we'll move out?
As I said earlier, the board has applied its mind in detail on this topic. Lot of discussions have happened on board, and the pros and cons of all possibilities have been evaluated very, very closely. And the wisdom still is that it is definitely worth it for us to continue in this business. As far as mindshare is concerned, they're two very different teams handling it. So really speaking, there is no cross flow of mindshare.
But as an investor, right? But as an investor, the numbers are being dragged down, which is the reality, right? So for how long is the question? So at what point would you say, fine, this is it, and then
I would not be. I think we look at it from a very positive mindset, and we will. And if it was negative mindset, why would we be in the business?
And we hope to get good.
We hope to get good numbers. Obviously, that's why we want to continue.
But is the worst behind us? But is the worst behind us in terms of numbers? Is this the base? Is this the worst phase right now?
We hope so.
Yeah, we certainly hope so. Yeah.
Great. Thank you so much. I mean, thank you for all the answers. We appreciate it. I mean, we've been investors for long, and we continue to be. So, I appreciate the answers. And also, a final word for Saurabh. I understand he's moving on, so I think it's been good to interact with him. So, thank you so much for all the years.
Can I ask you guys a question?
Yes, please.
And we keep wondering about this internally. We've been doing this investor calls for some time. Is there anything you would like us to do differently in the investor calls? See, we are not going to give forward-looking statements. That's a decision.
Which is fine.
Yeah.
No, I think
within the framework of our presentation, within the framework of our discussion, how do we benchmark versus other investor calls that you go to?
No, I think we are pretty happy with the whole calls. I think ultimately what you want is transparency and consistency, right? I mean, the only feedback I would give is the calls typically happen much later after the quarter ends. While most companies do it when the results come, right? Say a day or two after the results is a much better time to do it, versus a very long gap. It just it is not in sync with the whole with what the industry does. So apart from that, the questions and the answers, we are fairly happy because you're transparent. But the timing of the call would be much better if you can do it right after the phone call. That's after the results.
Thanks for the feedback.
Thank you so much.
Purva, you can move your question. Hello, Purva.
Hi. How's the response to Virtual Production Academy? And can we expand like certain kind of growth?
Yeah, I think let me explain the virtual production thing. Partly I did that in my preamble. See, virtual production, don't look at it as a separate business. We are not intending as that. It is, again, going back to my story of DNA. It's the technology of the future is what we believe today. As the wave comes, it will take us up just the way it will take up. Now, when the wave comes, we don't know. That's point number one. Point number two, which has also been asked by somebody earlier, it addresses a totally different segment which we are not adequately present today, which is the working professionals. People who are already working in the various studios, they are the prime audience. So our ability to reach out to them becomes that much easier. And they get very excited about it. Our batches have already started. In fact, it's in the public domain, so I can share that. We even have, we did recently a batch of students from FTII Pune, who are, let's say, the pinnacle of filmmaking in the country. They were here and they just completed a course with us, and those are likely to be ongoing batches for their students. So the whole idea of this is twofold. Of course, it is to be there as the technology involved, but even while it is there, to be able to increase our visibility amongst in the industry, gives us a chance to change the perception of Mac. Again, I think it was Ashwin or Sunny, one of them who referred to it, which was that Mac is an arena trade primarily for the entry level kind of thing, which is not true, which has never been true. But yes, I do recognize the fact that the way he is coming from in terms of perceptions. And therefore, this association of TVPA, which will also be an upgrade part to Mac and students, will also serve to change that perception which some people like Ashwin and Sunny may have carried in the past. And therefore, we are viewing this also as partly marketing and perception building, brand building for our existing businesses as well. But to be able to position that we are not an entry level technology player. Our customer segment may be more of that, but we are very high in our technology delivery. So it's not currently intended to be a separate business area, and we don't want, at least the near future, we don't want to do it like that.
Okay, but in near future, like, do we see some few more centers of VTA opening up?
Well, there is a lot of interest, Apurva. There is a lot of interest, but we want to, let this one mature like a pilot. Think of it as a pilot, go up the learning curves around various dimensions of delivery, and then we will look at expansion.
Okay, and
it doesn't take much. Once you have learned, see, that's been the beauty of Aptech, right? The scalability is, we know how to scale up. Doesn't take much for a month. And but we need to get every aspect of it right before we do that.
okay.
But yeah, there is a lot of interest. A lot of our existing partners, other people have inquired with us, and we've kept them on hold right now.
Okay, and other question is, why is it taking so long for Aptech to enter into newer segments?
Fair question. I think it's just that it's not happened. Having said that, we do know that we are carrying a substantial amount of cash in the balance sheet, which enables us. But we are not in the cash burn. As a policy, we don't believe in want to burn this cash away into just customer acquisition methodologies. And because of that, also we passed up some of the opportunities which came our way. But maybe we are currently, as we speak, in the process of drawing up a very cogent strategy. I'm not in a position to share details. And once approved by the pros, would be first committal move towards build of a 5-year vision of. We've got a 5-year strategy plan, and hopefully once it's the product public domain, we'll be able to share more.
Okay.
Suffice to say, at this stage, we are working very hard to be able to look at newer dimensions of things. But we are not going to be pressured into doing something which is there for the sake of doing it. Rather, we want to be able to do some things profitably.
Okay. Fine. And last question is, now the full integration with the new accounting policy is completed or it's still pending?
You want to take it?
We have more or less completed the process of migration, but there are, yes, quite a few students from the old system who are still moving into the new one. But the majority of it is done.
Okay. Thank you.
Thanks, Apurva. I think there are no further questions, so we'll end the call. Thank you everyone for joining us today, and we look forward to hosting you all again next quarter when the company hosts the call. Have a great day.
Just information, Mr. Saurabh Gada, who has been anchoring this role for us for a long time, is going into other entrepreneurial ventures, and we wish him all the best. Pawan, who's the CFO, in the time we have Saurabh's replacement, will continue to anchor investor relationships as well.
Thanks very much. Welcome to Pawan. All right, everyone. Thank you very much again, and have a great day. See you all again.
Thank you.
Thank you.
Everyone.